This is Eric L. Donovan, the Mindset Disruption Strategist. Let's talk about tax planning. More specifically, let's talk about two clear examples on why capital gains taxes are optional. But before we do not forget to subscribe to this channel and then make sure that you hit the notification bell so that you get an update on all of the new videos that we will have coming out. And you don't want to miss the quality and the new way of redefining success and thinking that I'm going to keep releasing. So let's talk about this. From a tax planning standpoint, one of the greatest missed opportunities that I see are people who are selling appreciated assets and then pay capital gains taxes. And I've had some other videos where we've talked about some tax planning strategies and we scratched the surface on this, but I really want to dig into more specifically on the capital gains side and give you two clear examples of why capital gains taxes are optional, especially when you can strategically work and think them out before you go into them. So as we get into this, I want to start with two examples. So the first one that I'm going to give you is, let's imagine that you've got a building that you're going to sell. And what I'm actually using here are some case studies of some people that I've partnered with to help them go through and rethink the strategies of what is happening and what they're doing. And I'm going to share these two particular case studies with you because they are so powerful. Now, these are not the only two strategies for avoiding capital gains taxes. But the number one thing, again, I think people miss is this concept and this idea that capital gains taxes are optional. You've got to actually choose that you want to pay them and do absolutely no planning. Because if you will sit down and do strategic planning, then there are opportunities to significantly reduce and sometimes completely eliminate the capital gains taxes that appear on a transaction. So let's talk specifically through this building sale that I helped the client with and show you how this can work. So here's example number one. What we had was Bob and Mary Smith, who had a $7 million building that they were getting ready to sell. So a buyer comes in and purchases the building from Bob and Mary Smith. So it's a $7 million building that has been severely depreciated. So a lot of capital gains taxes due. So $7 million, the federal and state taxes come in and say, hey, guess what? You owe us $2.6 million in taxes. Ouch, right? I mean, that's almost half, not quite half, but almost half of what the transaction was originally going out to federal and state taxes. That's just painful. And it can be avoided. It can be severely limited. And let me show you how. So this is just one idea. There are a lot of just different examples of how this could be done. But let's take Bob and Mary Smith again. And what if, and you have to do this before the building sells, right? You can't do this afterwards. You've got to do this before the building sells and before there's a binding agreement in place. So there are certain laws and certain rules. But what if they use a charitable remainder trust and gifted $5 million of the building value, not all seven, right? So not the total value, but $5 million of the building value into this charitable remainder trust. Now, to do this, you can't have any debt encumbered on the building, and there's some other rules. You want to work with your tax professional. You want to work with someone who has done this before and knows exactly what they're doing. But again, this is just one of many strategies that can help you avoid or eliminate capital gains taxes. And so remember, I also filmed another video where I talked about the difference between control and ownership. So when you have to maintain control and ownership, you are maximum taxation. In a charitable remainder trust, what you're giving up is ownership while maintaining control. The charitable remainder trust is technically owned by the charity who will get it when you pass away. The way that the charitable remainder trust works is you put the asset in, you get an automatic tax deduction. In this case, the $5 million created $380,000 of tax savings just automatically for making the gift. And as we will show you a little bit later, this charitable remainder trust is going to pay income to Bob and Mary for their entire lifetime. So they still have control of the asset. They can choose how it gets invested. They can get the income from it. So they still have control. They just don't have ownership of the asset any longer. And this creates a maximum opportunity to minimize taxes and create greater outcomes for themselves. So again, we created this charitable remainder trust. We put in $5 million of the value. The buyer comes in, they purchase the building, $5 million of it, they purchase out of the charitable remainder trust. Guess what? No capital gains tax inside of the charitable remainder trust. And then they purchase the building for $2 million directly from Bob and Mary Smith. So they retained control and ownership of $2 million. They're going to have to pay some taxes on that, $659,000 in taxes. And as I said, this charitable remainder trust is going to pay them, we're estimating about a 5% income a year. It's a minimum of 5 and it can go up from there. Again, you want to work with your tax professional to get more of the specifics, but they get an annual income of $250,000 for the rest of Bob and Mary's life, paid out to them. When they pass away, the $5 million goes into the Smith Giving Fund that can be controlled and directed by them on where they want that money to go from a nonprofit standpoint. Now, a couple of things here. One, I can hear some of you saying, but Eric, they lost, they couldn't use it for certain things. They could invest the $5 million. There are certainly ways that it can and can't be invested. Again, you need to get into the specifics, but this is an incredible tool for a lot of people who are in this situation. And you're like, well, maybe my heirs missed out on the $5 million. I'm going to tell you, there's other strategies out there to make your heirs whole, to where it really requires minimum capital outlay. And again, that would be something just worth having a discussion about. This is a one-off situation. But if you go into this world every single time going, well, you just got to pay capital gains taxes, I just want you to see they're optional. There are things you can do. And this is not going to cover the gamut of every single situation. But when you close your mind to what's possible and don't realize, hey, capital gains taxes are optional, I need to work with a strategic partner who can help me think through, then based on your specific needs, specific strategies can be found that will help you and help your heirs end up with probably more than you ever imagined, especially when you think about it strategically. So that's just one example. So let's look at, well, what happened? What was the outcome? Well, it reduced the taxes in the year of the sale from $2.6 million down to $659,000. That's a tax savings of $1.6 million. $1.6 million. You've heard me say this before as well. Every dollar you pay in taxes, you cannot use anymore. It doesn't work for your benefit anymore. So that $1.6 million is still working. So it increased the assets after sale that could be invested for income from $4.7 million up to $6.3 million. That's a 34% increase. And at a 5% ROI, that annual investment income after sale also increased by over $80,000 per year, which is another 34% increase. There's more money coming into the family every single year just because of this decision. And pretty cool, especially if you've got a heart for kingdom impact and making a difference in the world. There's a testamentary, which means after you die, charitable gift of $5 million, but it doesn't have to be made until both Bob and Mary are gone. I think this is a powerful, powerful tool that a lot of people miss out on because they're like, well, what are you going to do with the asset when you sell it? Well, I'm just going to invest it and take the income off of it. Well, in this instance, this tool becomes incredibly powerful and an incredible resource for you. Well, that's one way that you need to understand that capital gains taxes are optional. How about another way? Well, this is an S-Corp sale. Why do I bring up an S-Corp? Because in an S-Corp, a lot of times what your tax professional will tell you is, hey, you're just going to have to pay the taxes. Because of the way the entity's set up, there's not a whole lot that you can do to offset an S-Corp. Well, it is if you're not thinking strategically, but that's not the truth. There are tools out there that you can use after the sale is complete to still reduce the amount of capital gains taxes that you owe. And let me show you. This is a really pretty cool tool. So let's talk about what happens. So again, let's say Bob and Mary Smith, they have an S-Corp business that they're going to sell for $25 million. Again, this is a real case study of a client that we partnered with. In this instance, federal and state taxes amounted to $8 million. And then They took and put the money of 16.9 million into an investment account. Great. Things that they could do. Again, you've got control and ownership over that investment account versus the federal taxes, $8 million gone, never see it again, can't use it for your benefit at all. Get about $848,000 of annual income from that investment account at 5%. So that's one possibility. But do you really want to pay $8 million in optional taxes? What else might be possible? Well, again, we have a buyer come in, and because this is a tool we can use after the sale. $25 million purchase goes to Bob and Mary Smith. Then you can use a tool called a charitable pooled trust. This is a little bit different than a charitable remainder trust. A charitable pooled trust pays out to you the amount of income that it produces every single year. But let's imagine that they put $12,500 into the charitable pooled trust. Now, the dollar amount is going to be dependent on your situation and how that works, but I just want you to see the power of this tool and its possibilities, because this isn't necessarily right for everybody, but it may be okay and right for you depending on the circumstances, because capital gains taxes are optional. So what happens? Well, in this instance, they get $2.4 million in tax savings. The tax savings on a charitable pooled trust is much larger than that on a charitable remainder trust because of some things that are written into the tax code that you have to know about. But with the charitable remainder trust, you get more of a certain amount of income, whereas, again, the charitable pooled trust is paying out the amount of income that's in there. You really have to have someone skilled in managing this charitable pooled trust to make it work its max efficiency for you. But in this example, capital gains taxes are only $5.6 million. So we got a severe reduction in the capital gains taxes, still a lot, but a severe reduction in the capital gains taxes, and get an income of $625,000 a year. Money still goes into the investment account, $6.8 million still, and an annual income of $344,000. Same situation here. When the couple passes away, the $12,500,000 needs to go to the Smith Giving Fund, where they can direct to the nonprofits and charities of their choice. But come back to this idea of control versus ownership. By giving up control, you put yourself in a position of getting $2.4 million in tax savings. So let's look at the overall benefit here. So the reduced capital gains tax was $8 million. It went down to 5.6 for a tax savings of $2.4 million. Then we increased the assets after the sale for investment income of $16.9 million to $19.3 million. It's a 13% increase, an additional 13% increase. And so the annual investment income was $121,000 up per year. And then testamentary charitable giving of $12,500,000. Do you see the power of just thinking strategically? Again, these tools may not be the right tools for you. But when you run into a capital gains situation, this is just two tools out of a lot of different tools that are available. But two specific tools that could be used in a capital gains tax situation to severely cut down the amount of capital gains taxes that are owed. These are powerful. So the next time you're sitting down with a tax professional and they're like, well, you're just going to have to pay the taxes. Or if you're getting ready to sell an asset that has appreciation and your first thought is, well, I'm just going to have to pay the taxes. Stop. Capital gains taxes are optional when you work with a strategic partner who, A, understands your situation, understands the impact that you want to make, understands the generational prosperity that you're trying to create, and can work with you to create strategies that match the outcomes and intentions that you want to have long term. And isn't that what we all want? Impact and generational prosperity. Why give more money to the IRS than you have to? Why not make an impact? Why not impact the generations that are ahead of you? And when you understand that, you become one of the most powerful people who's here, because you're taking control of your situation. Thank you so much for being here. God bless you. Have a great day.